Hello, thanks for joining us today. We're going to be looking at, in this presentation, artificial intelligence. It's been a big, obviously, topic in the media, CNBC, basically everywhere you look in terms of investment and other areas. And we want to dig into it and see how we're incorporating it in client portfolios, really starting now. So the specific topics we'll talk about. What does exactly AI mean in 2024 as we sit now, and then go back in history and look at some historical context to it. We'll also look at, and this is quite important, obviously, there's all types of AI. You could define it in many different ways, but we want to, as investors, isolate the areas that will accrete value from AI. So it's great if it's working like ChatGPT or anything like that, but we want to, if we're investing in it, want to make sure that value will accrete to it over time. Want to address if there's a potential bubble or not around some of the companies involved in AI. And then lastly, we're going to look at ahead over the next 5 or 10 years and some predictions there. So we'll start with what does it mean in 2024 as we sit today? What does AI mean? So AI in some form is not new. It's been around for decades. Really, the first iterations of it, depending how you define it, started in the 1940s, 50s. We'll look at a chart of that in a second. So it is not new, but something has changed over the past year or two, really. Starting in 23, maybe the tail end of 22, early 23, a new era began with ChatGPT and other large language models, or LLMs they're called, and applications that are derived off of those. That's when really it hit the media and everybody started to talk about it. Once that happened, many different companies, both technology and really across the board, industrial companies, financial companies, JP Morgan is big into this, organizations of all types started to invest pretty heavily in AI software, into studying, researching AI, how it could help their businesses, into procurement of chips or semiconductor chips, and platforms to see if it can help their business become more efficient and more cost effective and productive. And then again, we've talked about this before, but it's very important to identify not just AI generally, but what areas in the financial markets, whether it be public or private, will accrue value over time. We want to be durable, permanent, or semi-permanent areas of valuable accretion, and we want to stay away from what could be commoditized models, things that are going to zero in terms of cost or fees, or temporary sources of value, but will not last. So we want to look at that and dive deeper into that before we make any investments for client portfolios. So the first thing we'll look at is AI of all types demands a tremendous amount of data and information. That's really what feeds AI, is information and data. So before we had enormous amounts of data, it was limited what AI could do. And this chart on the left here is by year, starting in 2010, going through estimated 24 and 25, the worldwide amount of data available. And obviously, as the internet became more widespread, more applications, more companies building on it, we just supply more data into the internet through pictures, videos, social media, text, articles, you name it. More and more data became available to AI models. It's sort of incredible to look at. 2014 wasn't that long ago, 10 years ago. There's been approximately a 12 times increase in the amount of available data worldwide over the last 10 years. It really has gone exponential since then. We don't see any reason for this to change in the future. And this explosion of data, which feeds AI, the more good data, quality data you have, and the more of it, the better AI will become. And this is really, over the last couple of years, has what's allowed AI to become what it is today. Much different level than it was 5 or even 10 years ago because of that data increase. And obviously, you cannot read the wording on the left chart, but no, that's no concern. Really, what this is showing is the quality of AI platforms and software. So this chart, going from left to right, starts in 1940 and continues through current day. And all the little dots with the different colors represents different iterations of AI or near AI back in the 40s and 50s. And what you'll see as you move up the chart on the vertical axis is more, deeper AI, more useful AI, more powerful, quicker AI. And what you'll notice is that blue shaded area coincides with that same period we just looked at. So starting in 2014 or so, data became much more explosively available for AI models to feed off of. And that is the same approximate time where this line of AI usage went from more linear to exponential. And we think that continues from this point forward, where we really see an exponential change in the quality use cases of AI because we continue to create an enormous amount of data in ever increasing amounts. So now we'll move on to what's most important in terms of investments in client portfolios, which are areas where AI and the use of it will, in our opinion at least, will accrue value. So the first set of companies or platforms that we think will accrue value from this are the data providers or data owners. So probably to nobody's surprise, Google, Meta, Amazon, Microsoft, other social media companies, a lot of the biggest companies out there own and have access to and are continuing to bring in tremendous amounts of valuable data. Google does it via an enormous amount of search and geo-tracking. Meta does it via social pictures, video uploads, posts, clubs, through their social media platform, WhatsApp and Instagram. Amazon obviously has a tremendous amount of data on ordering patterns and shopping and trends there. And then Microsoft is more business related, but all these companies have a tremendous amount of data, and that data is incredibly valuable for AI. And that's why most of these companies you see on the screen, along with, the Fantastic Four, the Magnificent Seven, some of the biggest companies out there in tech have done very, very well over the past couple of years. And we do think these are beneficiaries of AI on the data side. Now, a different level of AI value accretion, very different than what we just discussed and maybe less talked about, but we think important, is AI, in addition to data, demands a ton, insatiable demand for electricity. For decades and decades, electricity demand in the US has been relatively stagnant, maybe just increasing modestly each year, because even though we continue to use more and more devices and electronics, they have become more efficient. So it's sort of balanced out. However, it just demands a tremendous amount of electricity. You put that on top of, some crypto mining, you put it on top of cloud computing, you put it on electronic vehicles, electricity demand is starting to increase materially. And I don't want to say there's shortages of electricity, that might be overstating it, but there are bottlenecks in terms of getting the electricity we need to build data centers and to power the AI we would want to. So we are investing, and we think this is a more defensive, higher conviction way of doing so in utility companies, energy storage companies, transmission companies, and also industrial technology companies that have a tie-in to the smart grid, making the grid more efficient, monitoring systems, anything that makes the current electrical grid more modern, up-to-date, efficient, more connected will be beneficial. And we don't think this will just be a beneficiary of AI. We also think it'll be a beneficiary of the large amount of government money or funds coming in through the infrastructure legislation and the Inflation Reduction Act. So we really do like an investment here, and we have made this investment through the securities you see at the bottom. So FUTY, Grid, no coincidence there, and STRUX are all securities that hold allocations to this area. The next is one step away from the electricity generation is the compute power that is needed from AI. So AI, in addition to data itself, in addition to electricity, demands a lot of compute power. And where is that? That is mostly data centers, hyperscalers, and other digital infrastructure. And we want to be invested here. Just like electricity and data itself, data centers, there's an insatiable demand for data centers out there. So we want to be invested either in companies that, like QTS, that create or build data centers, Westinghouse, which is involved with that, along with mini power plants, if you will, that provide electricity to data centers. And Oracle and NVDA are different types of digital infrastructure providers. So we do want to be invested in data centers, hyperscalers, and other digital infrastructure. And we own this both through private infrastructure, private real estate. All these areas are moving more and more into data centers because the supply demand is highly in their favor. And we think this is a durable form of value accretion. Then this is certainly one of the areas that has seen a very quick, large price increase or valuation increase. And this would be NVIDIA is the poster child here. NVIDIA is up a tremendous amount, hundreds of percent over the last couple of years. And then along with that, it's pulled up other semiconductor chip manufacturers, Broadcom or designers, ASML, Applied Materials. We think the semi or chips is another area where any platform, any company that wants to incorporate AI into their business needs chips and the right chips to do so. So all these companies have seen a tremendous run. We like chips over the long term, but it has had such a large run. We don't want to overinvest at the current levels. We don't want to overweight this currently. If at some point we get a large pullback in semiconductors, then we might look to add specific exposure here, and we would do that most likely through the ETF you see at the bottom, SOXQ. That gives us broad exposure to all semiconductors. But for now, we have held exposure through here, basically through index and tech. So we own this through IVV, AVUS, QQQE. Between the three of them, there's a large exposure to semiconductors. This is becoming a very large part of the overall market. NVIDIA itself makes up over 5% of the S&P 500 itself, just the one company. So we have ample exposure here. But if we do get a big pullback in the industry, then we would look to put specific exposure on. And then the last area, and this is unique. Almost nobody is talking about this. Very few people have access to this type of AI value accretion, or companies are private companies. So this would be more niche-y, unique type of AI use cases. Some companies are Nanotronics, Databricks, Spring Corp, Verbit. You might not know these companies. They're not traded on any exchange. They're still private. But these are very interesting companies that are looking to do specific things. So a lot of these, one example would be where if there's a manufacturer of cars, for instance, they would bring in, say, Nanotronics, and Nanotronics would bring in all the data from the manufacturer of the cars. It would put it into its algorithm, AI algorithm, and then it would basically spit out what it thinks the manufacturer should do, essentially in terms of the floor plan, the layout, the machinery, the personnel, the software, the technology, basically everything in terms to make it much more efficient. And we're seeing more and more use cases here of industrial companies, manufacturing companies, healthcare companies use more niche-y type of AI to improve their operations. And these companies are private. We do own them through the securities in the bottom, PIIVX, XPMIX, and soon to be hopefully CPIIVX. But all four of these are actually owned in PIIVX, which many of our clients own. And it's a very high likelihood over the next 1 to 2 years, at least some of these will go public. And our investors would be on the IPO side of that. And we think these would do most likely quite well on the IPO. So, if you put all those 4 or 5 areas together of value accretion, we could get a nice, diversified, more stable type of broad allocation to AI, where we think AI value will accrue over the shorter term, but also over the longer term and more durable. So we really do think we weaved in AI into their portfolios in a measured, diversified way where it'll benefit our clients over the long term through this shift. Now, some people ask, is there a bubble in AI? Or is it got away from us? Is it crazy? Is there a mania going on? In certain areas and certain stocks, that's certainly possible. It's certainly possible. There is some stocks that are just up so much, it is tough to justify it. But this is a chart from Goldman Sachs who did some research on this. And basically, you could look at if the lines were exactly 100, if they matched with 100, they just sort of went right along the 100 line. They would be, any AI company would be the same performance as non-AI companies, just the S&P overall, equal weighted. What they're trying to show here is the black line, where they deem the companies that are benefiting from AI in the short term, so call it now or in the next year or two, something like that, they have experienced a huge run relative to the S&P 500. So they returned about 160, 170% more than the S&P. Some of these companies, like an NVDA, like some smaller publicly traded AI companies, maybe a couple other semiconductor stocks, maybe those are ahead of themselves, and maybe they do have to correct some. However, you notice the blue line, these are what Goldman Sachs views as long-term AI beneficiaries. So maybe this would be, maybe they're not seeing much now from AI, but maybe over the next 3, 5, 10 years, these should benefit from artificial intelligence. And those really haven't run up that much at all relative to the overall market. So we think some stocks certainly could come down. They could correct, 10, 20, 30%, especially the NVIDIAs of the world, things like that. But over the long term, in aggregate, we think this is a long-term story that has a lot of legs left to it, and we don't see a 2000-like bubble, at least not at this point. And then lastly, we'll look ahead. So where do we see this going over the next 5 to 10 years? So one piece of this is AGI, or Artificial General Intelligence, and this would be the next level where we have the LLM models now, like Chat GPT, and instead of really being told how to do something, you just tell them what you want, and it knows how to do it, or it figures out how to do it autonomously. And depending on how you talk to and what company you listen to, some platforms are possibly approaching this level of sophistication currently. So we're almost here, maybe not quite, but almost, and that would be a pretty big leap. We think that happens probably within a couple of years. If you go down, medicine, healthcare, biotech, we think there's a lot of room here for improvement in terms of, if we get all this data centralized, detailed, specific, gene, DNA sequencing, along with AI learning and putting all these different pieces together across the entire population, this could be a boon for healthcare, biotech, and individuals themselves. We think this could be a much more unique approach to medicine and much more effective treatments at the individual level. Quantum AI, basically that just means a lot more power for AI. So very powerful, robust, quick AI than current iterations. And that would just allow a more rapid development of advancements in many areas. And then lastly, it would be the combination of the software piece, is what basically we've been talking about this whole time, is the software, the platforms, the AI models, the data, and hardware. And hardware could be in the form of robots of some sort. And that combination could be powerful, as well as that would enter the physical realm, where everything we've talked about to this point, and AI to this point, has all been digital. Making images, videos, scripts, stories, poems, things like that, or improving algorithms or procedures. This would be taking to the next level, where we could actually use AI in the physical world. We think that's the furthest away. Very well could be, a decade or more away, but that is probably happening at some point. So that wraps up the conversation. I hope you enjoyed it. We are in all these areas as we speak in client portfolios to different degrees, depending on risk tolerance. And then any questions on any of this, you could email me, eric@tfgllc.com, or your Trap Hagen advisor. Thanks for paying attention. Have a good day.